financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rayam.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com.
Welcome to Financial Fitness. I'm Jess Tyler along with the Money Doctor, Dr. Francis Rayam. Hi.
Hi, Jess. How are you?
I'm all right. How's your week going?
It's going busily,
Yeah.
but yeah, no, it's great. Well, yeah, there's a lot going on everywhere in the market, in the workplace. There's plenty to talk about. But today we're going to talk about life insurance.
Okay.
Thank you for playing. No, not life insurance like all the boring details of life insurance. Life insurance from a consumer standpoint and partly from an agent standpoint. Now, you know, people have pointed out to me lately that they used to think of me like an insurance agent or an investment advisor, and now they think of me as a consumer advocate.
Okay.
So I feel like a consumer advocate, and I have been for many years. But something like this is a little tricky because, you know, there are lots of people in my industry who work with life insurance. I write life insurance very occasionally. I don't write many policies, but I wanted to talk about what might be useful to people to protect themselves against some of the less scrupulous things that are out there.
Okay.
Did I just say that? I did. Okay.
You did. And there's all different kinds of life insurance policies, right? We've talked about this,
my
that
gosh.
there's so many. Okay.
There's so many, but let's for our purposes today, let's just lump them under two categories: term life
Okay.
insurance and whole life insurance. Now,
Mhm.
I know people get confused about that. So if you think about term life insurance, it's good for a term. It's good for a period of time, and then it goes away. So it's good for a term of 15 years or 10 years or 20 or 30 years, right? And then it disappears.
Okay.
But it also has lower premiums. It is pure death benefit for a term, a period of time, right? Whole life comes in many different flavors and, you know, whole life, universal life, variable, universal life. I mean, there are blends out there. Anytime they can give a product a new name and give it new features, they do. But any form of whole life insurance under that huge umbrella will cost you more than term. Some not
Right.
very much, some a lot more, right, in premiums, but it will build some kind of cash value.
Okay.
Even a stripped down universal life policy that is what I call built on a term chassis. In other words, it's the least expensive of the whole life policies you can buy, but it still is permanent insurance like all whole life is. Even the stripped down basis of that will still build a tiny little bit of cash value just to stay alive. So
Okay.
the major two differences between term and whole life for our purposes today are cash value. A
Okay.
term policy doesn't ever build any cash value. It is you pay the money for a straight life benefit, and it will end whenever that term policy ends. Okay.
Is whole life, do you have to have a physical for that, or for both,
Excuse me.
or for some?
It depends on your age and the amount of
Okay.
coverage you're buying. But physicals are common. Sometimes it's just medical questions that you answer. You don't have to
Okay.
have a regular physical. Sometimes they'll do medical questions and a blood draw. You know, so the underwriting, that's called underwriting. The underwriting details are on a case-by-case basis, depending on what the company who is selling you the insurance requires of someone of your age and your health
Okay.
parameters. Okay. So there are two major things I want to talk about today, given that brief but probably still confusing background. I want to talk to people who are considering selling their life insurance policy for some reason. And I want to talk to people who are considering buying a life insurance policy for the purposes of paying off debt.
Oh, okay.
Okay. Now, let me tell you, there are times that both of these might make sense. But in my experience, there are many more cases that I see where it didn't make sense. And that's why I'm here to talk about it today.
Okay.
Okay. So let's talk about people who sell their life insurance policy. Now, these are called life settlements, right? And they come in different forms of life settlement, but most often they're available to people who are 65 years and older and or who are in poor health. Now, the idea is that you take your life insurance policy that you no longer need and you sell it for an influx of cash.
Okay.
This could, in theory, be a good thing to do, but there are many reasons it's not. So let's talk about the pros of that first. The pros of selling your life insurance policy. Well, the obvious one is you get immediate cash, right? You're going to get money in the door. You're going to get a higher payout than the surrender value. In other words, if you're looking at your life insurance policy and you're saying, boy, I really need this money and I'm tired of paying these premiums, what am I going to do? You might think, well, I'm going to surrender the policy. I'm going to cash it in and take the cash value, right?
Okay.
And that would give you some money. Now, that might also, we'll talk about cons too, but that might also cause a taxable event for you, depending on how much you've paid into the policy. But let's say the surrender value is $5,000. You could choose to say, I'm going to cash in my policy. That's a famous phrase, cash it in, right? And take my $5,000 and I'm going to walk away. And you will have paid all those premiums you paid over the years for no coverage anymore. You had coverage while you paid it, but then the policy is gone, okay? If you're going to sell that policy to someone, they're going to keep it in force, right? They're going to pick up the premiums and start paying them. Sadly, it sounds like, but there's no other way to say this, gambling on the date that you're going to die and they're going to collect. Whew, isn't this creepy? Right?
Who can do that, though? Your kids, you mean? Carry it on?
Well, the kids probably wouldn't buy your policy. They would probably just say, hey, mom, dad, I know you're having trouble paying those premiums. We'll pick up the premiums because we're going to be the beneficiaries. But other people, investors, believe it or not.
Okay.
And you see these ads. It's grim, yeah.
Yeah.
You see these ads on TV that say, you know, sell your life insurance policy. You know, that policy you don't need any longer. Well, it's true. If you have a life insurance policy that you no longer need, let's say you took it out and you were paying premiums on it when you had a bunch of debt and you were covering your spouse's income, et cetera, but now your spouse maybe has predeceased you. Maybe you don't have any debt, and maybe your kids are all working jobs and buying houses and living fat and healthy, and they don't need your money. Yeah. And they're okay with it. You could say, well, what am I paying these premiums for? I'm going to leave this money to charity. Maybe you want to do that, but maybe you don't. Maybe you just say, I don't want to pay for this policy anymore. In that case, if you qualify, and that again, usually you're over 65, usually you may be in poor health, but if you qualify, then you could find an investor, or they will find you. Unfortunately, they will find you and they'll say, we're going to buy your policy with your $5,000 of cash value. Now, I'm totally making these numbers up, right? But we'll give you, $8,000, $15,000, whatever they think it's worth to them based on your usually government expected lifespan. So what they're doing is they're making an investment. They're saying, don't cash your policy in, sell it to me instead. I'll pay you more than your cash value, but less than your death benefit. And you no longer will have that life insurance. I will own it. I will be the beneficiary on it. Okay.
Right.
So when you die, I get all the money. Now, one of the reasons they do this is because life insurance proceeds are tax-free. So from an investor standpoint, or from your beneficiary standpoint, this is a very nice thing to get tax-free income. Where it gets fuzzy for me is the negotiation part. How does somebody who's a skilled investor negotiate with somebody who's looking at what they believe is a useless policy, wanting to get some money out of it? So that's where it worries me. That's where I'm hoping regulation will happen, will step in, will make things safe for the consumer, right? Because you're kind of out there on your own in these kinds of things, and I worry about people with that.
If you just do a settlement without the investor, is it kind of like a 401k where if you take money out early, you get penalized?
That's a very interesting question. Yes and no. Now, you don't get penalized. If you can either, if you want to call it a penalty, if you cash your policy in and you give up the death benefit and you take your money and walk, you're not penalized by that other than the fact that you've paid premiums and now you no longer have death benefit. But you may have a taxable event if you paid in more than you're taking out, you won't have a taxable event. But let's say you paid in $3,000. I have to say I'm not an accountant, right? Let's say you paid $3,000 in and you took $5,000 out. That $2,000 may be considered a gain depending on the tax laws that year.
Okay.
And you might get a 1099 for that. However, the other way to take money out of your life insurance is to borrow against that cash value. Now, that can be a good way for people to do it when they need a short-term fix. Like, gosh, I have $5,000 in this policy and I need to do a car repair and I don't have the cash to do it and I don't want to put it on a credit card. Maybe I'll borrow against my life insurance policy for $3,000. And I'll either choose...
Bringing it back to the 401k for a minute, do you need qualifying events like you would there to borrow?
No.
Or you can borrow for any reason?
Yes, and you are borrowing your own death benefit. So this is where keeping a whole life policy could be a good benefit to you if this kind of scenario comes up. So you could borrow against the death benefit. Let's say you borrow $3,000 of your $5,000. Now, legally, that loan does not need to be paid back. You have borrowed against your own policy.
Okay.
But it will have an interest rate on it. So let's say the interest rate is 5%. Okay, or 4.25%. Every year you're going to get a bill for that interest. Now, if you just pay the interest, you'll keep that loan stable at $3,000. You need to understand that when you're borrowing against your life insurance policy, even though you're taking the cash value out, your death benefit will be reduced by that amount if you don't pay it back. So that's okay. A lot of people will say, so what? I had a $50,000 policy. I borrowed $3,000 from it. If I die tomorrow, it pays $47,000. I don't care.
Right.
The thing you want to be careful of is paying that interest to keep it from growing and growing and growing. You don't want to die and find out that your $3,000 loan became $20,000 over the course of time.
If you do decide to borrow, say you decide to borrow $5,000 out of your life insurance policy, do you have to get approved for like a loan, like a bank loan, or are you automatically like, hey, that's your money, you can take it?
It's your money, you can take it.
So
Probably
you really
take you about 10 days.
Using this as like a short-term loan kind of thing.
You could be, yes. And so that's another reason why, and I'm not trying to advocate either one or the other side of this. Truly, I'm not. There are reasons that these options make sense for people. What my message is get some help or make sure that you know what the reasons are. I want to go through some cons about selling your life insurance policy before we get to the break. And one of them is, of course, you're going to get a lower payout than the death benefit. So if you bought your life insurance policy to cover your spouse or your kids, and you cash it, you sell it, not cash it in, you sell it for, a quarter of what it was worth, you need to be able to reckon with that, right?
Yeah.
My recommendation would be talk to your family about it, make sure they're okay about it, because they might say, no, don't sell. Keep me on as a beneficiary. I'll pay the fees that you're having trouble paying, and I'll pick up the premiums. At least give here's my pitch on this. At least give your family the same courtesy that you're giving a stranger who might want to buy your policy.
Yeah.
Give them a first option to keep it, okay? There might be tax implications if you sell your policy. So again, maybe you've put, $15,000 into it and somebody comes along and wants to buy it for $20,000. That $5,000 might be a gain. And so you might end up holding less money than you thought you were going to. There are eligibility restrictions. So this is where I'm saying most of the time they want somebody who is either terminally ill, sad, but true. Which, by the way, while I'm saying this, if you are terminally ill and you're listening to this, check your insurance policy because you might have a feature you don't even know about on your death benefit that allows you to take 2 or 3 times the value of your death benefit while you're alive to pay for your health care.
Wow,
so don't give this up without checking first about what your benefits are. And obviously, you're going to lose that death benefit if you sell this policy. So that's the loss of the coverage is a major con. And then I guess there's 2 last things. One is that these companies will request or require access to your medical records and your personal data. So there's a privacy issue there for me. If that's what you want to give up, that's up to you. And then the potential impact on any government plans. If you're on Medicaid or any other needs-based plan, and you get an influx of cash from selling your life insurance, it might affect your benefits. I'm not trying to scare anybody. I'm just saying ask about it first.
Yeah, that's good to be aware of because you don't want to get like less of a check of something else. All right, we'll get into more of this coming up with part 2 of financial fitness. First, I'd like to get your number.
Thanks. Part 2 will be about what you do if you're thinking about buying a life insurance policy to pay debt. And our phone number is 413-773-3333.
And you can go to hugyourmoney.com. We'll be back with part 2 of financial fitness with the Money Doctor, Dr. Francis Ram on WHMP.
Financial Fitness with the Money Doctor is underwritten by Franklin County Technical School. We build futures. Visit fcts.us or call 413-863-9561.
Welcome back to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Ram. Hi.
Hi, Jess. You're hanging in there with me, and you're asking great questions. I love that.
We're talking life insurance, and there's a lot to it. We got into a lot in the first half. What are we talking about here? About the policies?
You know, I never thought that you would have so many questions about life insurance, that you would be so engaged. It was really surprising. But the point that the things that we're talking about are not your regular everyday life insurance topics, right? So in the first half, we did talk about life insurance if you're looking to sell your policy to bail out and get some cash. But along those lines, I want to point out that there are many agents now offering to get you out of debt by having you buy a whole life. Remember, we talked about whole life are the ones that build cash value, some form of whole life policy in order to build the cash value to help you get out of debt faster. Now, you probably know what I'm going to say already, but I will tell you that I'm sure there are cases where that makes sense for people. Particularly if they've already maxed out every other opportunity, okay? They've already maxed out their 401k and their IRAs and their savings, and they've got no place else they can put money, or they really need to build money on a tax-free basis to balance out their portfolio, and they have a need. Boy, I could say that about 6 times. And they have a need for life insurance, okay?
Okay.
In my book, now this is just my opinion, no need for life insurance, not the best investment. Somebody will argue with me, right? I can say that I have people in life insurance who use it as an investment. But that the part of the reason is because they need that or they want that tax-free death benefit for estate planning purposes. That in itself is a need, okay? So there are legitimate reasons to buy a life insurance policy. One, that have to do with debt, okay? One is protecting your family from debt. You own, you have outstanding debts like a mortgage, a car loan, personal loans, and you pass away, your family may be responsible for those debts, and a life insurance policy means they have the money to pay those. Before you decide that, ask an attorney or an agent to show you in writing which debts your family is responsible for, because credit card debt isn't one of them, okay?
Oh, it is one of them?
No, credit card debt gone.
Unsecured
debt gone, okay? So don't let some agent talk to you about your massive debt that you have to pay off, and therefore you need an enormous policy if most of it is credit card debt, or if you're single, okay? If you're covering co-signed debts or joint signed debts, right? If you have co-sign loans like student loans, business loans, mortgages, then your co-signer or your spouse might be responsible for paying for them. Again, you can check that. But having life insurance has a benefit. I'm not anti-life insurance. I never have been. I started in the business at John Hancock a bazillion years ago with life insurance and understanding the benefits of it. I'll tell you, there's almost no better feeling that you can do for somebody who is grieving than to be able to, if you don't know them well, right? You're not their family, you're not their loved one, then to be able to show up and say, here's the money tax-free to relieve you of the financial burden. Okay, that's really worthwhile. Okay, estate planning and final expenses, right along those lines. That's what you want to be able to do with a life insurance policy. You want to make sure that your bereaved spouse is not worrying about how they're going to pay the funeral expenses or the mortgage next month, right? And so that's what life insurance is for. And last but not least, I would say business debt protection. Those are all reasons you'd buy life insurance when you're trying to use it to ward off debt in some way. Those are legitimate reasons that life insurance policy helps with debt. Okay. Whew. Let's talk about what I don't like about it. What
Let me
I
ask
don't
a question
like,
right here real
yeah,
quick.
sure.
Do people overbuy life insurance, not the like overbuy the amount?
It's another really good question. So there are times when it makes sense to buy up a little bit. Life insurance is what we call banded, right? So you will get a better rate on $250,000 than you will get on $242,386.
Okay.
All right. So there are times that it makes sense to buy up. If a life insurance salesperson is trying, or an agent or broker is trying to sell you more insurance than you think you need or than you feel is right. And again, this might just be to leave it to charity, right? You don't have to have proof of debt to buy a big policy. You might just want some tax-free income or some tax-free, benefit at the end. But if you feel like you're getting pushed into, but you should buy more because of whatever, that's a time when you step back and say, I'm not so comfortable with that. Let me see if I want to buy that much insurance, if I can afford to buy that much. Okay. One of the things that salespeople do in order to get you to buy more more life insurance is what I said. They overstate your debt, right? They say, here, you have all this debt. Let me give you some guilt about that. You don't really want your family to have to deal with that. Here's why you need this policy, okay? These things are what I say are unethical, unscrupulous, morally lousy. They give the business of being in the insurance or the investment name. And there are plenty of people who deserve a good name in the industry. Again, if your dependents have co-signed debt, it could make sense for you to buy this life insurance. But if you're single and most of your debt would be discharged upon death, what do you care, right?
Yeah.
Now, here's the unscrupulous part that bothers me. The sales pitch is this. You're paying a lot of debt and you're paying your lenders. So why not bank on yourself and put your money into this life insurance policy? Because it's going to build cash value. And in a certain period of time, this cash value is going to be valuable enough that you can pull it out and pay off your debt. Doesn't that sound remarkably to you like the line from debt settlement companies that I complain about?
Yeah. Or anything that sounds too good to be true.
The difference is with debt settlement, they tell you to stop making your payments and you trash your credit. With this, they're telling you go ahead and keep making your payments and buy this life insurance. Now, I have so many reasons that I think you could do this in a better way. We won't have time for them all. But the least of which is not, if you can afford that larger life insurance premium, because it will take a lot of money to build cash value, less when you're really young, right? You're 20 years old. This might make sense for you in some way, but you should compare the numbers, right? But if you're 50, you're going to pay a lot for the death benefit and very little for the cash value. And it's going to take years, in any case, for this cash value to grow. In the meantime, you're still paying your creditors these lousy interest rates. And when you borrow this money out, there is an interest rate on it. So even if you pay yourself back, you're paying interest. And if you don't pay yourself back, you will eat up that death benefit in loan plus interest. Now, here's the big kicker. When you buy one of these policies and you wait until it grows to a large cash value and you borrow that large cash value, guess what you get with large cash value that you've borrowed? Large interest, right? You're going to pay interest over years. When that interest plus the loan grows to a certain level, if you have stopped paying your life insurance premiums, which is what a lot of people do at that stage, that policy will implode. In other words, you'll get a letter from the company that says, sorry, you've maxed out your loan and interest. Either pay it back or start paying some sort of higher premiums, or your policy will lapse. You will no longer have this death benefit. That's not the real problem. The real problem is when that policy lapses, all of that money that you took out that is in excess of what you paid in becomes taxable.
Okay.
Where is the agent that sold you this 25 years ago or 20 years ago or 10 years ago at this stage? Okay. It takes a long time to build that cash value. Now, I've had people say to me, oh, no, it has cash value right away. Really? Where did that come from? It came from someplace else that you could transfer it in, another life policy that you could transfer it in from, which you could have used for this already. So what I would prefer people look for is a better solution. Is it ours? Yeah, we're one of them for sure. But there are so many other better solutions than this in many cases, not in all cases, okay? So on a case-by-case basis, if you're looking at this for yourself, you want to be thinking, you really want to be looking at the details. Is it good for me? Am I young? Do I have a high enough income for many years that I can afford this extra price for a premium? And do I have a need for the life insurance? Then, yeah, there might be a reason to do it. But if you think about it, if you think about the fact that every premium you pay, part of it has to go to death benefit, and the death benefit in turn builds the cash value, right? Then obviously, if you could just pay that money towards, say, a high yield savings account, you would build that cash value more quickly. If you did something like our plan in combination with that, where you just paid off your debt, because we pay off the debt so quickly, we reduce those interest rates down in most cases to less than 3%. That's less than you'd pay on your own policy loan, right? So you could just do that. And if you have life insurance, you could pick up some term or pick up the whole life if that's what you want. But you don't necessarily need to do it with the idea that you'll wait all these years to get the money to pay off your debt. We could have it paid off by the time that ever happens. You have a question?
I did have a question.
I can see it, yeah.
Are the companies, like if you're taking a loan against your life insurance, is it kind of like credit card companies where they can charge whatever interest they want? Or are there any regulations on like you get charged 5% and that's it?
There are regulations. It's in your contract. And it will say either it comes with this 4.25% rate, or it comes with Prime Plus or LIBOR Plus, or there will be something in every contract that tells you what your interest rate will be. And you can check with your insurance provider about that. And that's a great question. You should know going in what, if you are going to borrow against that policy, maybe even before you buy it, what's that going to look like for you when you go to borrow it? But again, I'm not anti-insurance. I like the idea of building cash value in policies when it makes sense as part of a portfolio. But in my opinion, and in probably most economists that you would talk to or good financial advisors, we would tell you that a good, strong financial plan involves a separate plan for debt than it does for your life insurance. Can they be muddled together sometimes? Sure. But in general, I'd say know what you're getting into in either case, whether you're selling your life insurance because you're trying to get cash back or you're buying a policy because you're trying to pay off debt. Think about that twice in both cases.
This is definitely, I think, a topic where people could use some assistance. So what is your phone number if they have questions?
Thank you, Jess. Yes, it's 413-773-3333.
And we haven't mentioned in a little while, but I want to bring up again, too, if you have a question for the Money Doctor and you want to send in a question, we would love to get it. I love springing these questions on the Money Doctor, and she does not know ahead of time and always does so great with them. But you can send those in at jtyler@whmp.com. If we use your question on the air, you get a copy of the book, which is right behind you.
It is Retire Debt and Retire Well.
All right. Thank you so much. We'll be back again next week with another edition of Financial Fitness with the Money Doctor, Dr. Francis Ram on WHMP. Thank you.
Thanks, Jess.